Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, and it's December 4th. Hope you guys have a wonderful morning thus far. Uh, again, tomorrow the markets will be closed, so I won't be doing this report tomorrow, so we won't be back until Thursday. Now, as for data that will be released typically tomorrow, that most of that beige book. Now, this kind of for today, there's nothing on the economic calendar, so we'll just jump over to the headline news. Right now, the stock market is down because there's basically two things. Part of it is that there's some renewed skepticism over developing. It's been developing with investors over China-U.S. trade. They're kind of wondering when the 90-day moratorium begins, and there's been conflicting reports on when that date begins. Some people in the White House have said December 1st, and some other people have said January 1st. So we got some conflicting reports, and then kind of delving into the statements from both Chinese as well as the U.S. and China. So there's been a little bit of skepticism coming in there that maybe may not be as big of a deal or not. So time will tell. And again, they're kind of feeling a little more pessimistic today. But the biggest thing that this on investor mind really that's kind of driving the markets is concern over yields right now. Now I'm going to release later on Twitter the yield spread difference between the 2-year and the 10-year. But for right now, I'm going to show you kind of across the board here. Here's where the 2-year is currently at, and we're at 2.82. We just exceeded the 5-year Treasury here at 2.81 here. So now this is at a negative when you compare the 2-year and the 5-year. Now, why is this important? When the short-term rates, the 2-year yield, it becomes higher than the 10-year. Traditionally, we've seen it go into a recession after about 1 to 2 years on that. The short-term rates here. So this is why it's a concern. When the Fed's been raising the rates as they have been, and then lately the 10 years been coming down quite a bit. We're down to about 2.94 as you'll see coming up. That's going to be a concern. And we get this month the Fed's supposed to be meeting and raising another quarter point. That will push us into a negative yield position here, and this is what is concerning the investors. As they've been concerned about a slowdown. Now this could definitely push us into a recession in about 1 to 2 years. Typically, this will happen. And I'll show a graph of that again on Twitter. So if you guys want to see that, stop by Twitter, and I'll show you my my profile and everything, so you guys can look it up. But in any case, here's today's bond market. We're up about 9 basis points currently. We're up, pushing up against a double resistance. It's going to be a tough layer of resistance here because it's double. You got this Fibonacci here, level here, and you got the 100-day moving average moving down here. So you got this double resistance here. It's going to be very difficult for us to break up. Lenders, many of them did not reprice for the better yesterday, so they're giving that better pricing today. So we'll see better pricing today. Again, we got to be careful here because we're still in this overbought position here, and we haven't had that. It's kind of this sideways movement, and it hasn't had that negative crossover. So once that negative crossover develops, we'll see bond prices come downwards, which rates will rise here. So let's take a look at the 10-year Treasury. Right now, we're pushing down against the floor of support, which is the 200-day moving average. We got a lot of ways to go down to the next Fibonacci level, but again, I don't know if we'll make it, or perhaps maybe this will hold later in the day here. But we're down to about 2.94 right now. 2.94 percent here on the 10-year Treasury. As you can see, we're way up here, over 3%, even touching touching 3.25 at one point, just back in October. And now in 3 months, we're down here. We've had 2 rate hikes basically since then, and we're going to be having our third one, fourth for the year, coming up here very soon. So, anyways, again, rates are a little bit should be a little bit better today. The pricing for interest rates should be a little bit better. If you guys want to get any updates or any change of circumstances, come over to Twitter. You can find me at Mike Bjork, and again, I'll be posting that an update on what that looks like currently, the spread between a 2-year and a 10-year Treasury, and how close we are to a negative yield curve right now. All right, you guys enjoy the rest of your day. Thanks so much for watching, and we'll look forward to see you guys. Actually on Thursday. Bye-bye.